All right, let's get right into this explainer of Peter Lynch's legendary investing philosophy, which is totally designed to cut through all the noise and anxiety of the stock market. Listen, if you've ever felt completely overwhelmed by Wall Street's financial jargon, shifting economic forecasts, or just the relentless hype machine, you are definitely in the right place. Today, we're unpacking the core, timeless principles of literally one of the most successful investors in history, relying entirely on his own, unvarnished, no-nonsense advice. We're starting off with a massive pattern interrupt here. Lynch argues that trying to predict the economy is just a complete waste of time compared to looking at actual business facts. I know, it's incredibly tempting to want to know if a recession is right around the corner or what the Federal Reserve is going to do next, but Lynch says relying on macroeconomic predictions is about as useful as calling a psychic hotline. Instead of agonizing over an unknowable future, he focuses on what he can actually see today. Our inventory is piling up, our freight car loadings increasing, are people actually booking hotels? Just facts, not forecasts.
So here's our syllabus for today. 1. Ignore the economic noise. 2. Know what you own. 3. Dangerous stock market myths. 4. Avoiding long shots. And 5. Stomach over the brain. Let's dive right in.
Part 1. Ignore the economic noise.
So the absolutely crucial point to understand here is that predicting interest rates and recessions is practically impossible. As Lynch points out, even the so-called experts completely miss the 20% prime interest rates of 1982, the double-digit inflation, and the massive market crash of October 1987. Nobody saw it coming. Instead of trying to guess the macroeconomic weather, you just need to accept this really simple truth. The stock market goes up, it goes down, and it goes down a lot. Once you accept volatility as just a fact of life, you stop wasting your energy on economic tea leaves and start looking at actual individual companies.
Moving on to Section 2, which introduces his most famous golden rule. Know what you own.
Okay, so if you cannot explain to an 11-year-old in 2 minutes or less exactly why you own a stock and what that company does, you simply shouldn't own it. People love to buy into this incomprehensible tech jargon, right? Floating point data arrays, Unix operating systems, double metallization protocols. But when a stock like that drops, what do? You have absolutely no idea because you don't even understand the business. Now contrast that with Dunkin' Donuts or CVS. Simple, everyday businesses that you can actually understand and track. Lynch made absolute fortunes buying these mundane companies just because he completely understood exactly how they made their money.
Now, what's truly fascinating here is the sheer patience required. People constantly feel this frantic, buzzing FOMO, like they have to find a stock before sunset or they'll miss out forever. But look at Walmart. You could have been the most careful, skeptical investor in the whole world. You could have waited 10 full years after Walmart went public just to see if their business model actually worked. And guess what? If you bought it a full decade after its IPO, you still would have made 30 times your money as they rolled out their stores across the country. You literally have plenty of time in this business.
Section 3. Dangerous stock market myths. We're going to bust the cognitive biases that consistently destroy retail investors.
These are the lies we tell ourselves, especially when a stock is tanking. Just saying, well, how much lower can it go is a massive trap. Lynch shares this crazy personal story about buying Kaiser Industries when it dropped from 29 to 17. He thought, hey, can't go any lower, so they bought a massive block at 15. Well, actually, scratch that logic because it went to 9, then 8, 7, 6, 5, all the way down to 4. Stocks do not have a magic floor just because they've already fallen. Also, the idea that eventually they always come back, simply false. Think of all the obsolete technologies out there, from floppy disks to double knits. They don't have to bounce back. We also tell ourselves, I'll sell the second it rebounds to $10. Or we obsess over stocks we didn't buy, crying over imaginary lost money. Every single one of these is an emotional trap.
I absolutely love this rhetorical question because it addresses a fundamental misunderstanding of risk. People often think that buying a $3 stock is somehow safer because, how much can I really lose? But math tells us a very harsh truth here. Whether your neighbor puts $10,000 into a $50 stock that goes bankrupt, or you put your money into a $3 stock that goes bankrupt, both investors lose exactly 100% of their money. A low share price does not equal low risk.
Investors also love to buy into terrible industries thinking it's darkest before the dawn. They see bad numbers and just assume a turnaround is mathematically guaranteed. But Lynch highlights that terrible can get infinitely worse. Back in 1982, the oil drilling rig count fell from 11,000 to 6,000. People thought the business couldn't get any worse, so they bought in. But then the rig count fell to under 1,000. The exact same thing happened with freight car deliveries. Just because an industry is currently a disaster doesn't automatically make it a buying opportunity. Sometimes it's just darkest before pitch black.
This is a deeply psychological hurdle. You have got to take your ego completely out of the equation. People treat their stocks like their grandchildren or puppies, right? They hold on to a losing stock purely out of stubbornness, just waiting for it to rebound to the exact price they paid so they can walk away breaking even. But listen, the stock has no idea who you are. You could be the greatest, most charitable human being on planet Earth, and if you own a bad company, the stock is going to go down. If you own a great company, it'll go up. It's not personal, so stop treating it like it is.
Section 4. Avoiding long shots. Let's tackle the allure of the next big thing and the extreme danger of hype.
You know exactly what these are. You'll get phone calls from friends whispering to you about this miracle company that is absolutely guaranteed to be the next Xerox. The stories are incredibly seductive. They pitch products that will supposedly do everything from improving your child's spelling to literally ironing your pants for you. They're hyped up as these guaranteed home runs that will completely change the fabric of society.
But there is a fatal flaw with these whisper stocks, and it's always the exact same thing. They don't actually sell anything yet. The story is sensational, sure, but the profit is completely non-existent. Lynch explicitly warns that these are not long shots, they are no shots. He noted that out of dozens of these he tried, he never even broke even. Look, if a stock truly has massive potential and is rocketing to $300 a share, you can definitely afford to wait 6 months to see if they actually manage to sell their product first.
Which brings us to Section 5, Stomach over the Brain, and the ultimate takeaway on what truly makes a successful investor.
A lot of folks assume you need to be a math genius or a calculus expert to beat the market. You really don't. Lynch jokes that if you made it through 5th grade math and you can add 8 and 8 and get fairly close to 16, you've got all the brain power required. You don't need to calculate the area under the curve. What you actually need, the absolute key organ here, is the stomach for volatility. Can you handle seeing your portfolio drop without going into full-blown panic mode? Because there is always, and I mean literally always, a macro crisis to worry about. If you look at this timeline, back in the 1950s, people were absolutely terrified of another Great Depression and were building literal fallout shelters in their backyards to hide from nuclear warheads. You don't exactly buy growth stocks if you think the world is ending tomorrow, right? Yet ironically, the 1950s turned out to be one of the best decades for the stock market this century. Then came the oil spikes of the 70s, fears of a Japanese economic takeover in the 80s, global warming, commercial real estate collapses. There will always be a reason to sell if you go looking for one.
Let's just look at the hard facts for a second. Over a 96-year period, history shows us that market drops are incredibly normal. A decline of 10% or more happened 53 times. To put that in perspective, that is roughly once every 2 years. And a drop of 25% or more, a true bear market, happened 15 times, which is about once every 6 years. These declines are statistically guaranteed to happen. Having the stomach to ride out these perfectly normal drops without selling in a panic is your absolute greatest asset as an investor.
Which leaves us with this final thought. History tells us that despite every single war, recession, and crisis, the market will be vastly higher in 15 or 25 years. The real question isn't what the economy is going to do next week. The real question is whether you have the discipline to turn off the panic and calmly know what you own. Are you going to let the inevitable economic noise shake you out, or do you actually have the stomach to hold on? Think about that the next time you see a scary headline. Thanks for tuning into this explainer, and remember, keep focusing on the facts.